10% depreciation in year 2011. Some are really concerned that what we're seeing is a free fall of the currency. Is that an alarmist view?
No, it is actually, but we need to look at the factors influencing it. You remember way back last year and early this year, we got a facility of $500 million from the IMF to boost our foreign reserves. I think as an emergency loan, it comes with conditions. One of them is central bank to build up their foreign reserves to 6 months. Now, you realize they have not yet been able to hit that target. So once in a while, they have to keep coming to the market and mop $1, $2, $3, $4 million as they build up those reserves. That's on one side. But on the other side, again, central bank is doing both sides on the monetary policy as well. So interest rates are eating them up. And therefore, they have to keep on trying to regulate M3, probably try to do a bit of repos, mop a bit of some shillings, so that people don't have so much cash to chase the dollars. So I think as these ones continue, we are likely to see that instability in that exchange rate.
You know, having lost almost 10% of its value against the dollar, the Kenyan shilling now has the dubious honor of being ranked one of the 4 worst performing currencies in the world. What's needed to restore that confidence?
That's quite worse, and that's quite bad indeed. However, I think the solution lies with CBK in this particular case. Every time you are running fiscal policy clashing with monetary policy, you have to take one stand, and probably in this particular case, they may have to come strongly probably on the monetary policy and loosen a bit on the fiscal. We all understand this is June, and therefore we have only 2 weeks to the end of the financial year. So the pressure to raise 125 billion should be ending in the next 2 weeks. And therefore, that's going to give much more space and time for central bank to look at the issue of the shilling. So I think in the meantime, we should be seeing the shilling probably depreciating further. But I don't see it going very much further than probably 94, 95, because 2 weeks will be over, and then therefore they concentrate on managing it.
How do you respond to people who are saying that the central bank is giving the market mixed messages, mopping up excess liquidity as one way, and then lending on the overnight system being the other way? So there's just a sense that there's no clarity what it is that the CBK is doing. Do you think they know what they're doing?
No, I think I'm expecting that to happen. One, I think CBK and their trend reporting lines to Treasury, their number one emphasis as we speak right now, in June the 21st, is to be able to hold on the fiscal policy. And probably in this particular case, being able to build the foreign reserves as part of the agreements with the IMF on the $500 million facility. So I think that's number one. However, in the local market, then there are the concerns of monetary policy where we want to tighten in the availability of shillings in the market. And therefore, so they're trying to run both sides concurrently. And I think that's where the confusion comes in.
What about the carry trade? Because the Kenyan shilling is one of the few internationally tradable African currencies. And we're seeing bond yields spiking. We're seeing inflation rising. And there's just a sense that there's going to be a major sell-off of Kenyan assets. So to what extent do you think speculators are in the market? That's the first thing. And to what extent does the international market force have impact and bearing on the shilling?
Thank you very much. I think the first one, on the issue of how much speculators and where they are in the market, I think definitely no doubt. But I think you need to understand as well that every time central bank comes to buy even $1 million, analysts, traders, speculators, banks, and everyone reads that, look, here is CBK trying to show us the direction that this is the way to go. And therefore, people make the decision based on what central bank does. Now, we all understand that it may not necessarily be that they want the shilling to depreciate. They're just building the reserves. But that activity brings in the speculators, the traders, the importers, and the old dealers as well. So that's one side. Now, I understand that for the international investors, this becomes concerning, particularly if you look at, I'll give a statistic. If you invested in this market in 2007, you bought the shilling at about 67. And you bought probably 2 years later in 08, Safaricom at 5 bob. Now, 3 years later, the shilling has gone to 91.45, and Safaricom has come to 3 shillings and 90 cents. So actually, you have lost both sides. So that becomes a very bad market to deal with coming from outside Kenya. So I think those are issues to grapple with. But from where I'm seated, I think this should be able to continue for the next 2 weeks. And probably we see a total different strategy. And as you see, the president has been trying to push for lower interest rates, which I think is a fallacy because it can't happen with all these things happening. Yeah.
The broader impact on the economy, Fred, we're seeing that fuel importers demanding dollars, cereals producers demanding dollars. There's a fear that manufacturers are not going to be able to cope with rising input costs. So broadly speaking, things are just becoming a lot more expensive because of the shilling. You're saying we might see respite in 2 weeks' time, but others are saying this economy is really going to suffer the consequences beyond the 2 weeks.
Yeah, you're right, actually. There's the inertia, and obviously, as all these factors come to interplay, and they collude to make sure that interest rates are quite high, interest rates, as well as inflation is quite high, I think the real impact is going to come because of the lag. And I think the biggest loser here is going to be the Kenyan investor, because one, the purchasing power is being eroded by the day. And true, as you say, I think it's going to get worse for some period of time to come. Because look at this, most manufacturers are enjoying some stability on the lending front because many banks for the last 3 months have not really changed their interest rates, even as much as the interest rates for the government securities have really gone up. Only one bank came the other day and increased their base lending. But I'm expecting in the month of July to have interest rates raise, where a couple of banks come in and say, look, first half is over, we've seen what has happened, and therefore everyone starts increasing 50 basis points, 100 basis points, and therefore that competition is going to catch up with those manufacturers as well as the normal consumers and even the borrowers, because the existing loans have to be priced at the new rate. And I think this is going to be make things much more worse for the investor, particularly in the stock market. For the investor on the bonds market, is already affected because today we are looking about 900 billion worth of bonds listed in the stock exchange, and interest rates have moved like 400 basis points year to date. So those are massive, massive losses. But I'm expecting them to keep cutting on that and probably get a bit of reprieve when you see the new 20-year coming, which closed today, unfortunately, and the 5-year and the 2-year, and probably coming at higher rates as well.